Moving on in the accounting cycle, we are ready to talk about closing journal entries.
When a company closes accounts, they are preparing them for the next period. This is called closing the books. It is how the company distinguishes between temporary and permanent accounts.
Temporary accounts include accounts found on the income statement, revenues and expenses, and the owner's drawings account. The company closes all temporary accounts at the end of the period.
The other type of account are permanent accounts. Permanent accounts relate to the current and future accounting periods. Permanent accounts consist of all balance sheet accounts, assets and liabilities, and the owner's capital account. Permanent accounts are not closed at the end of the accounting period.
Closing entries produce a zero balance in each temporary account. When closing revenues and expenses, you close them to an account called income summary. When closing revenue accounts, you need to debit the revenue account for its balance and credit income summary. Doing this brings the revenue account's balance to zero, which closes it. The reason debiting the revenue account will reduce the balance to zero is because when you increase the balance of a revenue account, you would credit it. Because you need to reduce the amount in the revenue account to zero, you need to debit it for the amount in the account to do this.
When you close expense accounts, you debit income summary and you credit the expense account for the amount. Because expense accounts are increased with a debit to the account, the way to decrease the balance in the account is by crediting it. Doing this will reduce the balance in the expense account to zero.
Now that we closed all of our revenues and expenses to the income summary, we now have a balance in our income summary account. If income summary has a credit balance, it is considered a net income. If income summary has a debit balance, it is considered a net loss.
To close the income summary account, we either need to debit or credit the account depending on what its balance is. If income summary has a credit balance, then we have a net income. This is closed to the owner's capital account in the following journal entry on the blackboard. We debit the income summary because it has a credit balance and we need to reduce it to zero. And we credit owner's capital to increase the balance because the owner's capital account increases with a credit.
If the income summary account has a debit balance, this is considered to be a net loss. To close the income summary account to our owner's capital account, we would need to follow the journal entry on the blackboard. When the income summary account has a debit balance, it means the company earned a net loss. In this case, we would need to credit the income summary account to reduce its balance to zero. We also need to debit the owner's equity account because when a company makes a net loss, we need to subtract that amount from the owner's capital account to show it has decreased. We do this with a debit.
Now that we have closed our income summary account to owner's capital account, we now need to close our drawings account to owner's capital. When we close owner's drawings to owner's capital, you need to debit the owner's capital account to show it will be decreasing. In addition to this, you need to credit the owner's drawing account. Doing this will reduce the balance in the owner's drawing account to zero, which closes the account.
Now you know what you need to know about closing journal entries. Go close those books.